Back in episode 3, we watched 146 governments try to build digital money and fail. The United States banned its own digital dollar. Europe slipped years into the future. Cash survived. So here's a question nobody asked at the time. If the digital dollar was cancelled, why are there right now over $300 billion of digital dollars in circulation? They exist. They move around the world every day in seconds for almost nothing. People hold them, get paid in them, save in them. They're dollars, just not made by the United States. They're made by companies. And while everyone was watching the governments, private firms quietly did the thing the governments couldn't. This is the story of the new money printers and the biggest shift in who issues money in 150 years. To understand what happened, remember why central banks wanted a digital currency in the first place. Cash was fading. Payments were moving to cards, apps and networks run by private companies. And central banks looked at that and thought, if we don't build a public digital money, the future of money will be owned by somebody else. Then they hesitated. Privacy campaigners pushed back. Politicians took sides. The project slowed, shrank, and in America were banned outright. But the demand didn't disappear because the old system has a genuine problem. Sending money across borders is slow and expensive. A bank transfer can take days and lose a chunk to fees. Billions of people either can't get a dollar account or pay dearly for one, while the dollar remains the currency the whole world wants to hold. So a gap opened, a worldwide demand for digital dollars that move instantly, and no government willing to supply them. Somebody was always going to fill that gap. And the people who did weren't central bankers. They were technology companies. The thing that filled the gap has an unglamorous name, the stablecoin. Strip away the jargon and it's simple. A private company takes a real dollar from you. It holds that dollar in cash or in short-term US government debt. And it issues you a digital token that says, this is worth $1 and you can redeem it for $1 anytime. That's it. It's a claim on a company's reserves, moving on the internet. Not a cryptocurrency that swings wildly. And the entire point is that it doesn't move at all. It's a digital receipt for $1. And it turns out the world wanted this enormously. By the middle of 2026, the stablecoin market was worth roughly $310 billion. Two issuers dominate it, one holding around $184 billion, another around $73 billion. Analysts at one research firm have projected the market could pass $1 trillion by the end of the year. And major banks' researchers have suggested it could reach several trillion by 2030. Those are forecasts, not facts. But the direction is not in dispute. Now hold that next to something we established in episode 3. Governments launched 3 CBDCs in 3 small countries, and one of them was largely ignored by its own citizens. Private companies issued $300 billion of digital money that people actually use. The scoreboard isn't close. For years, this was a grey zone, huge, fast-growing, and barely regulated. Then, in July 2025, the United States passed a law that changed everything, the Genius Act, the first federal framework for payment stablecoins. What it did was straightforward and enormous. It said, you may issue digital dollars if you follow the rules. Hold one real dollar or short-term government debt for every token you create. Submit to audits, guarantee redemption, get licensed. And crucially, it declared these tokens are not securities, lifting them out of the reach of the securities regulator and placing them under banking supervisors instead. In one stroke, private digital dollars went from legal grey zone to regulated financial product. And the response was immediate. Bank regulators began approving charters for firms to operate as digital currency trust banks. The largest stablecoin issuer launched a US-regulated token. America's biggest banks, the same institutions that spent years dismissing all of this, started building their own. Think about what that means. The United States banned its central bank from issuing a digital dollar, and then wrote the rulebook that lets private companies issue one instead. It didn't kill the digital dollar, it privatized it. So is this a good thing? That depends on whether you think we've done it before, because we have. For much of the 19th century, this is exactly how American money worked. There was no single national currency. Private banks printed their own banknotes, thousands of different designs issued by thousands of institutions. A note was only as good as the bank behind it. Travel far enough and yours might be worth less or nothing. When a bank failed, the money in your pocket failed with it. That chaos is precisely why national currencies were created. Now look at today. Digital dollars issued by private companies, backed by reserves you have to trust are really there, redeemable as long as the issuer stays solvent. The rules are far stronger than the 1800s. Real audits, real reserve requirements. But the underlying shape is the same. Your money is a claim on a company. And there's a second worry coming from the banks themselves. If digital dollars are easier and faster than a bank account, money may simply leave the banks. One major bank's chief executive warned that trillions of dollars in deposits could eventually shift if the rules allowed these tokens to pay interest. A US Treasury advisory body identified trillions in everyday deposits as potentially at risk. Those are estimates and warnings, not predictions of certain doom. But banks lend out deposits. Move enough of them and you change how credit works in an entire economy. Which brings us to the question this whole season has circled. Not is this technology good or bad, but who do you want holding the thing your life savings are made of? A government you can vote against? A bank you can regulate? Or a company you have to trust? 9 episodes ago, we started with a simple question. Who actually makes the money in your pocket? The answer turned out to be a hidden world. A handful of secretive companies printing the currency of 140 nations. A British giant that supplied both sides of a nuclear rivalry and nearly destroyed itself. A German firm whose paper fed 2 of the worst hyperinflations in history. Forgers in a concentration camp who made the finest fakes ever produced. A mechanic from Quebec who printed $250 million and walked free. Secret patterns hidden in your banknotes that your own devices obey. And a perfect counterfeit that no one has ever been convicted of making. Every one of those stories was really about the same thing. Money is not paper, and it isn't code. It's trust, manufactured, defended, attacked, and occasionally betrayed. Every company, every forger, every government in this series was fighting over the same fragile thing, the right to be believed. And now that fight has a new front. The state tried to build digital money and stopped. Companies built it instead, and the world is using it. Whether that becomes the greatest upgrade in the history of payments, or a return to the private money chaos we abolished a century and a half ago, is being decided right now, mostly out of sight. Which is where this series has always liked to look. That's the end of Season 1. Thank you for watching. Genuinely. Season 2 goes deeper into the machinery. We'll go inside the 200-year-old family firm whose presses print the overwhelming majority of the world's banknotes, the empire behind every empire in this series. We'll follow the money into the vaults and to the shredders where it goes to die, and we'll look at the metal underneath it all. Who really holds the world's gold, and whether it's where they say it is. Subscribe, and I'll see you in Season 2.